It's time to roast some more of your portfolios. We're going to be reviewing 5 different investment portfolios, plus there's a brand new quickfire round to hopefully provide as much help as possible. There are some caveats which I'll put on screen. Of course, most importantly, none of this is financial advice and this is just an educational roasting. It's just for fun. But at the same time, it will be helpful and there might be some actions you can take to implement in your own portfolio. I got these submissions via Instagram, email, and comment on my last YouTube video, so feel free to comment below and you might be in next video. Right, let's get into it. Jack has 2 portfolios. On Trading 212, he's 89% stocks and 11% gold. Gold has performed great in 2025, but usually it's a wealth preservation asset, and over the long term, stocks do normally outperform gold. Just pointing that out, there's nothing wrong with that split, Jack, as long as that's intentional. However, with the stock ETFs, there is quite a lot of overlap. I do like how half of the portfolio is in the FTSE All World, a low-cost global ETF. But all of the stocks in the other ETFs will already be in the global ETF. Looking at these ETFs, Jack has a tilt towards US stocks, AI stocks, emerging market stocks, and Chinese stocks. Once again, no problem if this is intentional, just make sure it is. Many people add more and more ETFs to their portfolio for the sake of it with no real purpose and then end up much more concentrated in specific countries or specific individual companies than they realize. In Jack's case here, he's going to be very heavily weighted towards US stocks and emerging market stocks because of the ETFs in his portfolio. Jack also has a second portfolio with Vanguard, and once again, there's a bit of overlap and a bit of concentration. But the concentration this time is with UK stocks. First though, on the overlap, these 2 funds, the Life Strategy 100 and the FTSE Global All Cap, are both low-cost global mutual index funds. They both invest into thousands of stocks around the world, which is great. However, as they're both global funds, they're essentially doing the same thing. So there's a lot of overlap between what these 2 funds invest into. Secondly, on concentration, the Life Strategy Fund has a massive home bias towards UK stocks. Personally, I prefer market cap weighted global funds such as the FTSE Global All Cap. And in the FTSE Global All Cap, UK stocks only make up about 3.5% of the fund because that's what UK stocks make up of the total global market cap. There's a similar thought process to the FTSE All World VWRP. So this was me. I would simply just use the FTSE Global All Cap to eliminate the UK home bias and stop the overlap between these 2 funds. Portfolio 2, we have Reese. Looking at this portfolio, we have 16% in the S&P, 7% in the All World, and a massive 77% in individual stocks. And there's also a tiny amount in a China ETF and gold. The thing that stands out instantly, that's a massive allocation towards individual stocks, and there's even 35% in one individual stock. But everyone has different goals, risk tolerances, and investment preferences, so let me give you 3 things to think about, Reese. Firstly, what do you actually want to invest into? I'd say work out a split between stocks, ETFs, and gold of your portfolio and then try and stick to it. And that avoids that issue of just adding random investments to your portfolio for the sake of it. Secondly, as you've got a lot in individual stocks, what is the actual investing case or hypothesis? Don't normally whip out those sorts of words on this channel, but what is the hypothesis for each individual stock pick and really for each investment in your portfolio? The stock picks have been brilliant. You've made some great gains, but it's difficult in my opinion to stay on top of the research required when it comes to stock picking to get that edge to beat the market. Not to mention that with individual stocks, there's much higher volatility. It also can be much more stressful due to that volatility, and you normally need to have a plan of when to exit the position. Thirdly, do you need this many positions? Can you simplify it? If you can simplify it, I'd say you'd understand the approach a bit better and you'd be much more likely to stick to it for the long term, which I think is half the battle of investing, actually having an approach you understand and get, then you can stick to it and just funnel money into that portfolio each month. It is the start of the year, so now is the best time to get your own investment sorted. If you're looking to finally start investing, to take control of your workplace pension, which is your money and it is being invested, or you just want to feel a bit more confident with your investing strategy and approach, click the first link in the description and that's exactly how I can help you out. Although it does kick off in 1 week, so if you're keen to get involved, be quick. One more portfolio, then we'll come on to the quick fire round, and we have Rajen's portfolio. I hope I pronounced your name correctly. Rajen has a huge amount invested, which is amazing. They also mentioned to me they have no mortgage, so they've clearly done very well in life, which is fantastic. Saying that, if you are watching this, don't feel disheartened. There's really no point in comparing yourself to anyone else. in anything, but particularly when it comes to investments. Everyone has different advantages, different starting points, a different journey. But back to Rajan's portfolio, we have about 90% in stocks and 10% in bonds. Given that Rajan is a little bit older, I would say make sure this stock to bond split aligns with your risk tolerance. Target date retirement funds automatically sort out your split of stocks and bonds over time. As this is a collection of funds, you will need to manually increase your bond exposure over time, assuming you wanted to take up more and more of your portfolio as you approach retirement. It's also worth saying, as once again, this is a collection of funds, you will need to manually rebalance between stocks and bonds each year to get back to your target percentage. Of the stocks, we have about 50% in the FTSE All World, a common low-cost global ETF, which I love to see, and about 50% in sector or theme-specific funds. Rajan did say to me when he emailed me that this tilt was intentional, which is completely fair enough. So my main question is, do you really need all of these different funds? Once again, I feel like the more funds, the more complicated the approach is, the less likely you're going to stick to it over the long term. What is the purpose of each of these investments? There's 10 funds in total. I'm not massively anti this, given you're in a great financial position and you have a massive portfolio size, so you definitely can take a few risks, but it's worth considering if you could simplify your portfolio and have more money in the FTSE All World, then you're ultimately simplifying your approach, not trying to beat the market, and just simplifying and cleaning up your investment portfolio. Time for the quick fire round. These were all YouTube comments that I got on my previous roast video. Dean, on small caps, they sometimes outperform, sometimes underperform. In recent years, they have underperformed due to the dominance of US large cap tech stocks. However, personally, I prefer to be as globally diversified as possible, so I like to also invest into small cap stocks. If you use the FTSE Global All Cap, that does include small caps. Most global ETFs don't include small caps, VWRP, FWRG, ACWI. So if you want to have small cap exposure, these two ETFs are good options. I personally prefer the top version just because it's lower fee and it's a bigger fund size. Although there are thousands of small cap stocks, due to their low value, they make up a small part of the total global stock market capitalization, around 14% in total. So if you did want to have small cap exposure in your portfolio, you could add one of these small cap funds with a weighting of around 14%. Although saying that anywhere between 10 and 15% is probably fine. Jar, switching from the life strategy fund to a market weighted global fund is a good decision in my opinion. Ultimately because that removes the home bias of the life strategy fund. Then having 10% in a theme specific ETF is fine in my opinion. It's a satellite and a small part of your portfolio, not the core, which is that global fund. But as you pointed out, that part of the portfolio will likely be more volatile because it's more concentrated in fewer stocks. Alan, you've thought about it and this is clearly intentional, which I love. My only question would be, are you needlessly overcomplicating it for the sake of it? Well, of course, if that's the approach you want to take, that's no problem. The beauty of investing is you can really split your money however you want and invest into whatever you like. Mrs. Infinitus, I like this. 2 low-cost funds with a focus on dividends. But if you want my opinion on the easiest way to simplify this and improve your approach, just use one low-cost global ETF. You seem to be a fan of Vanguard's funds, so VWRP is Vanguard's version of that. With your current portfolio split, you are quite heavily weighted currently towards US stocks. Pentragon, I like your approach. You've got a tilt, which is an active investing decision, but once again, like other people in this video, you've clearly thought about it. If you can keep that 80% in the FTSE All World, then that can do the heavy lifting for you and be the backbone of your portfolio, whilst you take a few riskier bets and theme-specific bets with the other 20% of your portfolio, the core satellite approach. In terms of the actual specific all-world fund, you could use Vanguard's version, VWRP, or Invesco's version, FWRG. ACWI is another ETF which is similar, and this tracks the MSCI All Country World Index. So that's another option if you wanted to look into that global exposure part of your portfolio. Scott, I don't know your amounts, but overall, I love how each account just has one fund, keeping your approach unbelievably simple. Saying that, you are heavily concentrated in US stocks. So I would just say, consider your concentration and consider potentially allocating more money to global ETFs to prevent that US concentration. Mandel, you are correct that the FTSE All World already has emerging markets in it. However, one point to make here, which is probably quite important if you're a UK investor, you probably don't want to invest into VOO. That is denominated in dollars and is an option for US investors. If you're in the UK and earning in pounds, you're going to want to use, in most cases, an S&P fund that's denominated in pounds. Vanguard's version is VUAG, but there are other options from iShares, Investco, and other providers. This is a common mistake that often comes up due to the dominance of US investors and US personalities on social media and YouTube, but by using the pound version, if you're in the UK, you'll avoid FX fees when investing. AMPH, two things that I like. Number one, the simple nature of your two-fund portfolio, and number two, you're paying very low fees, an average of about 0.11%. But, and unlike many other portfolios in this video so far, you're actually underweight US stocks as XMWX excludes the US, and that means you're overweight a lot of other developed countries like the UK and Japan. And the only other point I'd make as well is through this portfolio, you have no small cap exposure. Just once again, like a lot of the portfolios in this video. Quick fire round over. Maybe it wasn't that quick in the end. We did go through quite a lot, but hopefully that's all helpful. Let's get back to the portfolios. Next up, we got Naveen. Naveen, overall, I like your portfolio. These are all accumulation funds, so the dividends will be automatically reinvested, making your investments hands-off. I also like how the biggest position, once again, is a global fund. Of course, there is overlap. I've worked it out, and Naveen, you're around 74% US stocks compared to the 63% roughly market cap weighting of the US in the global stock market. But looking at your splits, it does seem conscious and intentional, which is great. The tilt towards the US is because of the additional AI fund and NASDAQ fund that you've got in your portfolio. And there's also an additional tilt towards emerging markets due to the additional EM fund in your portfolio. It is worth pointing out, and I mentioned this earlier, but by adding additional funds into your portfolio on top of a global fund, that is an active investment decision. You're ultimately adding more funds to try and increase your returns and beat the market. But as long as you realize this, it's on purpose, it's intentional, all stuff I've said before, then that's no problem. It's ultimately your money and you can invest into whatever you like. I do appreciate though that the one global ETF and done approach can be boring. So if doing something like this helps you stick to the long-term plan and compound your wealth, then that's no problem at all. And overall, Naveen, I like this. Let's move on to our final portfolio. Now this one is similar to Jack's from earlier on in the video. There is quite a lot of overlap, but this time, I'm sorry to say, it seems a little bit unintentional, and I think this person, in my defense, did know that. The 3 points I would make. To illustrate this with numbers, there's about 75% in US stocks and 20% in emerging market stocks, compared to market weights of around 65% and 10% respectively. So your portfolio is over-concentrated in those two areas. Secondly, the top two funds are income. They are distributing. They pay the dividends out as cash. I'm not sure what the bottom two funds are as the screenshots cut off, but the point to make is when you're investing, invest in the share class that suits you. I personally stick to accumulation funds, so all the dividends are auto reinvested, but you might prefer to see the dividends hit your portfolio each month because that's motivating for you, or because you might want to live off of the income. So just pick the share class, accumulation or income to suit your preferences. Thirdly, there's also a small position here in a crypto ETF. Although it's only a small part of the portfolio, I thought I'd just quickly tell you how you could invest into it and the different options that you have. Number one, you can invest into it directly. That's how I personally do it. I use crypto.com, but you could use Coinbase, Gemini, Kraken. There's loads of exchanges out there. Just make sure you're paying low fees and the exchange is reputable, although that can be much more difficult to come across in the crypto world compared to the stock market and bond market world. Secondly, we can now actually invest into crypto ETNs. So you could invest into a Bitcoin ETN. So rather than holding, for example, Bitcoin directly, you could indirectly invest into Bitcoin through a Bitcoin ETN. It was in October of 2025 that the FCA made these available for retail investors, and you can also invest into these ETNs now inside ISAs and SIPs. If you're worried about the admin and hassle of directly storing crypto, this could be another option to get some exposure. The third way is through crypto ETFs, and that is what this person has done here, where you essentially invest into an ETF where the underlying companies are associated with crypto. So if you want some crypto exposure, pick the best option that suits ultimately your preferences and needs. And that is a review of some more portfolios. We've talked a lot in this video about global funds. So if you are interested in working out what is the best global ETF for your own portfolio, watch this video here where I've ranked the best global ETFs for UK investors. I hope this portfolio review was also helpful, and feel free to leave your own portfolio in the comments below and I'll try to feature it in the next video. Thanks for watching and have a great day.